This spring, home buying season has been ripe with speculation about a housing bubble. And whenever the topic of bubbles is raised, there is always the question of whether the bubble will burst with a crash or gently ease back to earth in a modest correction. Since the Federal Reserve decided to increase interest rates from their near-zero levels, mortgage rates have hit a 12-year high, putting greater pressure on housing costs. In the face of housing affordability at a decade low, the home buying frenzy that shook the real estate market is beginning to decline, indicating a more remarkable change is ahead. Hello and welcome back to the Finance Guardian channel. In this video, we'll discuss why the housing market hasn't crashed yet and what banks don't want you to know. So hit that subscribe button and the bell beside it. Let's get started. Freddie Mac's chief economist Sam Cater said, while springtime is typically the busiest home buying season, the upswing in rates has caused some volatility in demand. It continues to be a seller's market, but buyers who remain interested in purchasing a home may find that competition has moderately softened. When home buyer demand dwindles, there's two likely outcomes: a correction or a crash. A correction involves a gradual drop in prices to more sustainable levels. At the same time, a crash would be triggered by either a wave of foreclosures or a rapid drop in prices, caused by a widespread panic among homeowners and investors. However, given that homeowners have leveraged $3.2 trillion in home equity and mortgage lenders have enforced strict standards, it is unlikely that there will be another real estate crash, particularly one like that of 2008. The housing market today isn't as bad as it was back then. While the COVID-19 housing market has drawn many comparisons to the mid-2000s real estate market, they couldn't be more different. This is not the same market of 2008. First American's deputy chief economist Odetta Kushi said, "It's no secret the housing market played a central role in the Great Recession, but this market is just fundamentally different in so many ways." The housing bubble that led to the 2008 financial crisis was caused by cheap debts, predatory lending practices, and complex financial engineering that placed many borrowers into mortgage obligations they just could not afford. The situation sparked a foreclosure crisis among homeowners and a credit crisis among investors who own mortgage-backed bonds, resulting in a global recession. The real estate market is in a much better position this 2022. The average American household has rebuilt its nominal net worth to pre-recession levels, and lending standards have tightened while home values have surged. So if you were hoping for a significant downturn to get a cheaper house, you better think again. Housing experts predict the market will remain strong for a while due to several factors. Number 1. Housing demand among millennials is up, with Gen Z right behind. As of July 2019, there are 166 million potential homebuyers in the United States who are either millennial-aged or younger, making up half of the U.S. population. According to data from the National Association of Realtors, this is significant because first-time homebuyers account for the largest segment, 31%, of people purchasing homes. And first-time buyers are mostly younger than 40, meaning there is a large pool of buyers. This indicates demand will remain strong, especially since housing inventory is at historic lows. Since inventory has barely increased in the past 10 years, the housing market won't experience a downturn. Gen Zs will turn 30 in a few years and be more financially prepared to buy a home than millennials were at their age. As a result, the demand for homes will be as high, if not higher, while inventory will still lag behind the demand. Number 2. Supply cannot keep up with demand. The severely low supply is also helping fuel demand and higher home prices. This is another reason why housing experts say the market will remain strong for years. The primary reason why home prices have risen so quickly is the supply-demand imbalance. And since home builders haven't built nearly enough houses for the past decade, it will take at least several years to balance the market with new supply. In a balanced market, the months of supply would be roughly 6 months. That is how long it would take to sell all available houses at the current sales pace. However, in today's market, there are only 1.7 months of supply, demonstrating a dramatic imbalance in favor of sellers. It is a good sign that new home construction increased in February at an annual rate of 6.8%, the fastest growth since 2006. Even so, home prices won't be adversely affected by the nearly 1.8 million new home starts. It will take time to reduce the housing stock debt we have accumulated, says Kushi. The imbalance will continue to put upward pressure on house prices even if they moderate from the peak pace of growth in 2021. Number 3. Borrowers are less likely to default on their mortgages. One of the differences between the housing market today and that of the 2008 housing crash is that lending standards are tighter because of lessons learned and new regulations enacted after the crisis. This means that those approved for a mortgage today are less likely to default than those approved in the pre-crisis lending period. In today's market, it's rare to come across a lender offering so-called quote-unquote no-doc loans where the applicant doesn't need to provide proof of income, something that was common before the housing crisis. There are also specific standards for government-backed loans, such as minimum credit scores and down payment requirements. In addition, regulators now require lenders to verify a borrower's ability to repay the loan, among other standards. In the fourth quarter of 2021, there were more than $1 trillion in new mortgage originations, with 67% going to borrowers with credit scores above 760. This is considered a very good score in terms of FICO standards. Russia's war on Ukraine is not helping the economy. The already rising energy price is being pushed up even further as the US and Eurozone have banned Russian oil for its invasion of Ukraine. A rise in energy prices will continue to fuel inflation, which could cause people to cut back on spending along with rising interest rates. Consumers may be less likely to buy homes as well. According to the latest Consumer Sentiment Index from the University of Michigan, consumer confidence fell to a 10-year low in March. As compared to last year, the index dropped 30% to 59.4. The survey shows respondents were anxious about the potential impact of Russia's invasion of Ukraine on the U.S. economy and high inflation and oil price increases. The U.S. oil embargo on Russia can cause supply chain problems to worsen, thereby contributing to already high inflation. When the cost of goods increases, consumers find it increasingly difficult to make large purchases like buying a house. Apparently, geopolitical conflicts are the wild card and could continue to impact inflation, causing it to persist longer than initially expected. Due to this, the Federal Reserve will begin to remove its accommodative policies, including rising interest rates. If mortgage rates spike, we might see more softening in the housing market. What home buyers should do. Today's market presents tough choices for home buyers. Home prices are predicted to continue rising and new home construction is expected to lag behind, putting buyers in tight housing situations for the foreseeable future. This means moving from big cities into more affordable metropolises for some buyers. For others, it means compromising on size or other amenities or stretching their budget. There are also buyers willing to take a risk and waive critical contingencies such as a home inspection to sweeten their offer. If there are major problems with a house that are not detected by the seller during the inspection, it could cost them even more in the long run. On the flip side, grabbing a house now, even if it means sacrificing other purchases, could save them money in the future if home prices and equity continue to rise. Getting a house and locking in a rate before rates and home prices rise could also save them money. On the other hand, the opposite can also be equally true if there is a risk that limited supply coupled with rising inflation could get so severe that it decreases prices and hurts the housing market, particularly if the economy enters a recession. If we fail to address shortages in housing supply, we run the risk of fueling the fires of inflation rather than extinguishing them. The result could be stagflation, a word most of us haven't used in a generation, high inflation and economic recession, says President and Chief Executive Officer of the National Housing Conference, David Dworkin. This would devastate the housing economy and only exacerbate our current housing supply challenges. If home prices drop suddenly, buyers could be stuck with underwater mortgages. It means they have to stay in the house until the market rebounds or sell and lose money. Housing experts predict such an event is unlikely, but the possibility should not be ignored. This can be seen in bidding wars or when buyers pay over the appraised value of a home. In some instances, this tactic may be effective. However, it must be carefully considered whether the house, neighborhood, and amount of time you will spend in that house will be worth it over the long run. It's also essential to consider how long you intend to stay in the home in this market. Those who buy their quote-unquote forever home have less to fear if the market reverses since they can ride the waves of ups and downs. Those who intend to move within a few years are at greater risk if the market collapses. This is why you would need to shop at the outset for a realtor and lender who are experienced housing experts in the area and whose advice you can trust. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.